Knowing these concepts can help you call BS on the numbers. For that $5 cup of coffee is actually costing me an extra $14. Am I making wise investments in myself? Hey everyone, I'm Devon Coombs, CPA, MBA. I also teach at San Jose State and used to work at Deloitte and then Google and did a ton of IPO and financial strategy work in the Bay Area around top IPOs. And now I am an advisor to CFOs and CAOs and do a bunch of other fun technical finance work. But today I am going over my second lecture in my Business 101 series. We're going to talk about some very essential topics like business structures, financial statements, financial statement analysis. So I'm excited for everyone watching today. This is part of my mission to give you top quality business education resources from the best, bringing in the best thoughts and best case studies I've seen in my entire career to make it relevant for my college students and also accessible to everyone else in the world. So let's get started with business structures. So there's really three groupings of business structures and a lot of subgroupings within them. It's important to understand these different types of businesses because they all have different tax consequences, especially in the United States. They have different types of legal consequences and ultimately risk profiles. So it's really helpful to understand how these flow so you can structure your taxes and accept the appropriate level of risk. The simplest type of business is a sole proprietorship. And what this means is it's just you. It's just you and you start a business. In the US, you don't need to create a DBA, a doing business as, or really file any legal paperwork to have a sole proprietorship. All you need to do is collect money and make sure that you have a tax identification with the government, with your state and federal government, so you pay taxes related to your sole proprietorship. That's all you have to do. So the real benefits are you're just a person starting a job. So if you go and start washing cars, tutoring, any of these types of simple services, it's really easy to start. But the problem is there is a lot of liability. So you are responsible for all of your related debts. And so this is a concept called commingling of funds. And so if you're a sole proprietor, normally you might have one account, that's your personal account and your business account. It's better to have two different accounts. You might have one personal account and one business account. But regardless, if you owe a business liability, let's say you're washing cars and then you break the car window, the person who owns the car could come after you personally if you have a sole proprietorship. You aren't protected. It isn't just your business funds that are at a loss. It's your entire personal net worth. So there's a real risk here. Really easy to set up, but then people can really come after you if you have any type of liability with your business. Also, all of your taxes are just on your personal return, which really simplifies things, but it also has some negative tax consequences if you don't structure it correctly. The real benefit here is it's just easy to start. You don't need any paperwork. You don't need any attorneys, no real tax professionals other than to file your taxes at the end of the year, even though it's always beneficial to hire all of these people to help you. So if you're just starting a small business, so my recommendation in these situations of when are you going to use a sole proprietorship? If you're starting a small business, you're not sure how fast it's going to grow. You're kind of expecting revenue to be less than $100,000 a year, and you really don't have a ton of liability. Like let's say you're just doing tutoring. There's really no good case to go beyond a sole proprietorship. You don't plan on scaling it. You really have no real personal liability. You're just tutoring other students. Like no one's going to sue you in that situation. Again, this isn't legal advice. To consult your tax attorneys and your attorneys for professional advice, but that's the kind of ideal portfolio or ideal profile of a sole proprietorship. As soon as you start having risk where you're working with people's assets or legal liability, then that's when you want to think about these other types of structures. So again, an example here could also be a local freelance graphic designer who runs everything under their own name. Really limited risk profile there, and you're just making graphic designs for other companies, so you really can't break much. But still, there might be benefits to expanding beyond that and going through these other structures to get some protection. The next type of business, which everyone should be really careful with, is partnerships. And so again, there's lots of different types of partnerships. You can hear about limited partnerships, limited liability partnerships, but for this course, we're just going to talk about what is a partnership overall and the benefits. So a partnership is owned by two or more people. That seems implicit in the name, right? Partnerships, well, we're working together. The challenge and the benefit here is that partners share profits, losses, and liabilities. So we can also create substructures called the limited liability partnerships that can protect against this liability risk. But the real partnership share is a benefit and a curse. If you have two people involved in every decision, if you have a loss or you have costs related to your business, you guys are going to share it, which is great. But also if you have profits, then you have to share the profits. And so this can quickly get ugly unless you structure it very carefully. Let's say you have two friends that go into business and one friend starts doing a lot more than the other friend. That harder working friend is going to look at the 50-50 profit share pretty quickly and say, hey, this doesn't seem fair. I actually want 70% of the profits. Well, too bad. If you didn't structure your partnership relationship at the beginning, you're in trouble here, right? You're not going to be able to get that. And so that can create bad blood. And quite honestly, a lot of partnerships go south pretty fast unless you have lawyers up front structure it in a way that protects you for the ebbs and flows of life. You can almost think of this like a marriage. Like you better know that partner really, really close before you get into business with them, or there could be some risk. Taxes get shared. They get passed through the partner's personal returns based on the sharing of profit and loss. And these are pretty easy to start, right? You could go to a bank with your friend and you can sign a partnership agreement. There's just essentially a piece of paper saying, we are going to work together and share profits and losses 50-50, doing X, Y, Z. And then you can start your business. Again, it's advisable if you're going to take this seriously to get an attorney or a tax attorney to make sure you're structuring this in ways that's really beneficial for the partnership to last in the long term. And for partnerships, my personal advice is you probably want to do that sooner rather than later. It's very different than a sole proprietorship. As soon as you get with someone else, setting expectations up front, it gets really sophisticated and it can get very challenging. So I see a lot of young entrepreneurs fall in this trap. They like somebody, they work really hard with them, and they work really well together. But then as soon as they start making money or they start putting in significant effort, they start having disputes and then the business falls apart. And so that could really be alleviated up front by being intentional with your structuring. So an example here, a lot of law firms and CPA firms actually work with partners. And so you might have 3 CPAs working together and they all specialize in something different. Someone might be a tax professional, someone might be an audit professional, and another person might be an advisory professional. And they all start a firm together because they can bring in their own profits and then divvy up work between each other. So that's very common in CPA, certified public accounting, and law firms. The last type of business structure we're going to cover today is called a corporation. So there's different types of corporations and corporation elections, but again, we're just going over the broad structures. This is owned by shareholders. And so corporations actually have relatively complex structuring. You have to have shareholders, you have to have a board of directors, and then you have to have management of the company. We'll go into that in more detail in future lectures. The shareholders of a company have limited liability. That's the real benefit. So you can own part of your company, and then the company is a separate legal entity. So if the company has assets in it and debts, so let's say you start a company and we're doing the car wash again, and the company is the car washing company, and you break someone's window, the person whose window you broke would have to sue the car washing company if it was a proper corporation. And if that corporation didn't have enough money to cover the lawsuit, the person's tough out of luck, right? They essentially can't pursue you unless there's other legal loopholes that they go through that we can explain in our business law overview. So it's a real benefit, right? You're actually protected. So your home is safe, your personal assets are safe as long as you follow some rules, which we'll cover in the future. Taxes also are different. You can have different elections. You can have a C Corp or an S Corp election. You can also have an LLC, and all of those result in different tax consequences. The corporation might get taxed, and then you might get taxed, or you could pass through the taxes to yourself. There's different benefits for doing either, and we'll cover those in more detail in the tax section. But the idea here is you have more tax flexibility, but it could also result in more consequences. And this is a more complex structuring where you really should have a lawyer and an accountant really involved. And then these are not so easy to start. They're more complex. There's more regulations. You have to do regular filings. You have to make sure you're paying like all the others, but you have to make sure you're really filing your taxes correctly. It gets registered with your state. There's a lot of complexities here, and you want to make sure you do everything right, or you can get tagged with legal fees. And there's normally legal fees with starting these up. So example here is like Tesla. That's a public company, but there's a lot of other people who make their own personal companies and do this as well without them going public. So we'll talk about private versus public in the future as well. But Any of these could be corporations. So here's just a fun thing you could play with. What would you choose for the following? A mobile car detailing with one van, a small accounting firm with two friends, and a tech startup seeking investors. And so like a mobile car detailing with one van, we talked about you might want to do a sole proprietorship, but you also might want to do a corporation if you're really worried about your liability there, if you might break something or scratch a car. Small accounting firm with two friends, maybe you're going partnership, or if you want to get liability protection, we can talk about LLPs, limited liability partnerships. Tech startup seeking investors. Once you have the investors involved, you probably want a corporation of some kind, a C Corp or an S Corp. So it's easier to raise funds because then instead of having to bring on additional partners, you can just sell shares of your company. So there's benefits and risks to all of these, and it really depends on how you want to structure your business towards your goals. So thinking of that, if we want to set our business up correctly, the next aspect is how do we know we actually have a successful business? And how we do that is through financial statements. So our financial statements have a flow, and that flow is going to start with your income statement, which generally flows to figure out what your equity was, which goes into your balance sheet, which tells you what your company looks like at a point in time. And then you can figure out your statement of cash flows, which tells you how cash is coming in and cash is coming out based off of a grouping of activities. So income statement, first off, you just want to know if your company made a profit or had a loss. So this shows how much money a business made or lost over a period of time. That's really important. Income statements are over a period of time, not at a point in time. So an income statement will be over a year or over a quarter or over a month. A balance sheet will be at a specific date. So key sections in an income statement include revenue, expenses, and that netting those out, revenue minus expenses is going to equal net income. So revenue, you got to remember these formulas. Revenue and expenses equals net income. Remember, net income is different than gross profit. I really want everyone to remember that because people get confused with it all the time. So your gross profit is going to be your revenue minus your cost of sales. And that gets you to your gross profit. And then you'll have operating expenses, which gets you to your net income. And so there's multi-step income statements, one-step income statements. All of these are different ways to divvy up how much money you received, where the money went, how much money was left with the company at the end of the period. So an example here is a bakery sells $10,000 worth of bread in a month, and they spend $6,000 on ingredients and wages. They earn $4,000 in income. You can also look and figure out, well, we could divvy up the wages. If some of those wages were to bookkeepers, that might go into expenses. And if the ingredients would all go to your cost of sales, so you could figure out your profit versus your operating expenses there as well. The key takeaway here is you'd be able to figure out how much money was brought in, where the cost landed, and what ultimately drove the income at the end, and if it was profitable or at a loss. So profit and earnings aren't the same. Make sure you learn that earlier rather than later, and it'll quickly make you more differentiated than anyone who doesn't have a business education. Let's talk about the balance sheet now. The balance sheet then is going to be prepared after you prepare your income statement. So that income statement is going to tell you how much money you made, how much money you lost, and then you're going to flow that balance into something called retained earnings on the balance sheet. That's going to be your accumulation of gains or losses over time. And then the balance sheet is going to show you what the company owes or owns at a single point in time. So that's going to be your assets. That's everything that your business owns. And that's divvied up by what you owe and what you have claims to. You can figure out how much of that cash is borrowed, like you took from the bank or is on credit cards, or how much of that cash is through your own earnings, through money you've saved over time. And that gives us this beautiful equation, assets equal liabilities plus equity. A business is what they own, ownership rights to, their assets, is divvied up by what they owe to other people and what they've accumulated for themselves. That equity portion is really like what they've contributed through their own personal savings or what the business has built over time, the kind of money that they've retained over time. That's called retained earnings, or losses if they lost money over time, versus everything that they borrowed. So an example is if a bakery has $5,000 in cash, $2,000 in equipment, and owes $3,000 on a loan, you could think of this as it's easy to figure out what their equity balance is. They have $5,000 in cash, $2,000 in equipment. So they have $7,000 in assets, right? 5,000 plus 2,000 is 7,000. Then we have a $3,000 loan. That's $3,000 in liabilities. That difference, the 7,000 minus the 3,000, gets you your equity, the $4,000. You are already becoming more sophisticated in business finance. If you look at a company, you can say, hey, show me your income statement and balance sheet. And you should be able to see if a company's profitable, what's driving the profit, how much of a profit are they having, and then is the company liquid? Are they able to pay their debts in a short period of time? Solvent? Are they able to pay over a longer period of time? Is the business in good standing? Like, are your assets generally more comprised of equity or of liabilities? So it's really helpful, key concepts to get. That ultimately flows into a concept called cash flow statement. So the purpose of this is to show how cash is moving out of the business over time, over certain sections and categories. That includes operating activities, investing activities, and financing activities. So operating activities, your day-to-day business cash. So if you're making a sale and you get cash for that sale, let's say you're a tutoring business and you get cash that day, that'd be cash receipts for operating activities. If you spent money to drive to your tutoring business, that would be cash outflow based off of your operating activities. Investing activities, what if you're buying a long-term asset? So you had to buy a car in order to drive around to do your tutoring business. That would be an investing activity. A cash outflow from investing activities. If you sold that car later, that would be a cash inflow from investing activities. And then you have your financing activities. What if you borrowed money in order to finance your business? You'd have a cash inflow from financing activities. And as you pay off those loans, it'd be a cash outflow from financing activities. So if the bakery brings in $4,000 from sales, spends $1,000 on a new oven, and borrows $2,000 from the bank, we'd have $4,000 inflow on our operating activities from the sales, $1,000 outflow on our investing activities for the buying of an oven, and $2,000 inflow from financing activities from the bank. And then you'd be able to figure out what your net cash looked like at the end of the period. $4,000 less the outflow of the $1,000 to get you to $3,000. And you have an extra $2,000 from the bank. So you have $5,000 of cash at the end of the period. So now you can really get a holistic view of, well, the company might be doing really well, but are they managing their cash well as well? You can build a financial statement if you had revenue and expenses. So you all might be asking now, why do we have an income statement and a statement of cash flows? It seems like we do. Well, not really. So there's a real challenge in accounting that you might earn income and revenue earlier than you collect the cash or later than you collect the cash. Same thing with expenses. You might pay for an expense like a salary after you've incurred the liability, right? If you pay people every 2 weeks, they've been working for those 2 weeks. You need to do some type of accounting in order to determine how much you owe at any given point in time. This is what we'll call accrual basis accounting, and it's different than cash basis. So the key here for accrual basis versus cash basis, accrual basis is revenue is recognized when it's earned, while cash basis is recognized when you receive cash. That can be different, right? You could work for someone for 2 weeks, make money, and then bill them the next month. You would have accrual basis revenue in 1 month and cash basis receipts in the following month. So if you have to have electricity that you're paying every 2 months, you should expense it every month. You should take the average cost and expense it over a month, or the actual cost over a month, rather than when you get the invoice or pay the cash out to pay the invoice. Well, the cash flow will go out when you actually pay that invoice. So cash basis accounting means you're not looking at the timing of the receipts of cash flow or exflows of cash or flows out of cash flow compared to your compared to how you're earning or incurring revenue and expenses. So cash basis, you're recording revenue when cash is received. You record expense when cash is paid. It's simple, and a lot of small businesses do this, and a lot of people do it for their personal finances, but it doesn't really give you a good picture of what you owe or how you incurred your costs. So like if you mow a lawn in July, get paid in August, and record the income in August, that's a cash basis. But if you were on accrual basis, you would likely record that in July. This can actually give you really lumpy and not useful data. And this is where, like on a personal finance level, people make a lot of mistakes. Like if you buy a $30,000 car, a lot of people forget that that car costs $30,000 on day one. And so instead of remembering that cost, people drive around the car and say, it's cheaper to have this $30,000 car because it costs me nothing every single day. But in 5 years, if you're driving that car 20,000 miles every single year, 5 years, you're probably going to have to get a new car. So what would be better to do is to incur the cost, what's called depreciation, over the life of the car. So taking that $30,000 and dividing it by 5 and recognizing that expense every year would give you a better depiction of how much that car was actually costing you. And then you could layer in things like maintenance and gas costs and all of that. And you might realize, oh, it actually costs me 70 cents for every mile I drive. So when I'm driving 10 miles to go get coffee each way, that's actually an extra $7 each way to get coffee. So that $5 cup of coffee is actually costing me an extra $14. So let's talk about accrual basis. And that's really what it is recording revenue when earned, even if cash isn't received yet, and recording expenses when incurred, even if the cash hasn't been paid yet. So this is required by generally accepted accounting principles. If you want to be a public company, or if you really want to secure debt or get bought by other companies, you need to apply some semblance of generally accepted accounting principles. And so those are the rules to make sure that you're applying these concepts consistently and accurately with other companies, other public companies. This gives a more accurate picture of financial health. And this would be the example of if you mow the lawn in July, then you would likely recognize that revenue in July rather than in August when you're paid. And so this can be for private companies and for public companies. But if you're taking your business really seriously and you're trying to raise capital and you're a corporation, you generally want to start following GAAP rules sooner rather than later. You also have a benefit from just getting better reporting information, like we said about understanding your cost drivers, like the example of driving that car. Cash basis is when money changes hands. Accrual basis is when the job is done. So just remember that, right? Cash basis, if money's changing hands, that's when you would be cash basis accounting. Accrual basis is when you've completed the work on either end. You've incurred the cost or you've earned the revenue. So this is important with fraud, right? One of the reasons we've done generally accepted accounting principles and the reasons it's so complex and you need to get educated on this is because companies game the system. And so now you should know how to get around that game. So let's say a company reports $100,000 in revenue in December 2025. You're looking at the March 2026 statements and you don't see any money from cash flows. So the $100,000 in revenue didn't show up in the 2025 cash flows. It's not shown up in the 2026 cash flows. What happened here and could be the reason for the difference? And you can explore it yourself, but one of the good reasons could be, hey, they recognized the revenue, but they never collected on it, right? And so then there's a question of, should they have ever recorded that revenue in the first place? Was that revenue fraudulent? Hopefully you would see in the 2026 financial statements a write-off explaining that there was a bad debt or something to that regard. But I've seen this in my personal business. We've seen it when you buy companies where companies misreport information, like misrepresent sales. This is called fraud. It's highly illegal. In order to try to get people to buy their companies, they're tricking them, right? They're trying to trick people. Once you do the due diligence work, you find out that actually the company was full of crap and they're not worth what they say. So you knowing these concepts can help you call BS on the numbers. So now that you know accrual-based accounting, financial statement analysis, and the different types of businesses, now you can combine that to figure out financial ratios and financial analysis. So what's financial analysis? So now you can look at those numbers and understand what the business is actually doing. It's used by managers, investors, banks. So if you own a company, you can look at the numbers and make determinations. If you are an outside investor or if you're lending them money, you can figure out if it's a good quality company, and it helps answer if the business is healthy, if it's growing, it's in trouble. Would you make that investment? And the ways you can compare are you can find trends like how's the company doing this year versus future years, this quarter versus future quarters, month over month. You can look at industry standards and see if the company is doing well compared to other companies in the same industry. You can see if the business is paying its bills, if it's able to be liquid or solvent, we'll talk to, and check if profits are growing. There's just no end to the value of financial analysis. It can really help you make a decision of, like, if your friend says, hey, can I borrow some money? You could say, well, can I see your financial statements? And can you justify how my investment in you will grow over time rather than just be used on beer? So it's really helpful to have this lens, and it's just a constructive way to think of your own personal finances as well. Hey, how is my money doing month over month, year over year? Am I actually able to pay my bills? How am I doing compared to other people? You could look up like standard net worth comparisons and income comparisons for your age. The big picture is liquidity. Can you pay our bills soon? Profitability. Are we making money? And efficiency. How well do we use what we have? And so liquidity, can we pay our bills soon? It's the big one here is the current ratio. It's our current assets divided by current liabilities. If your current liabilities exceed your current assets, your business is in trouble. You need to make some money to pay your current liabilities. It means your credit card debt is higher than the amount of cash you have on hand or anything you can convert into cash. So as soon as you see that, that's a warning flag. Same thing for yourself. If your current liabilities, your credit card debt's bigger than your bank account, you're in trouble. You need to go to your parents. You need to take bigger loans. You need to get a better job. That ties in with this concept of solvency, but there's also ways to look at longer term assets and longer term risk. Like companies might be trouble in the short term, but okay in a long term and vice versa. Profitability, if a company is actually making money. So for every dollar sale they make, how many cents are they making? For every $100 they sell, maybe they're making $90, keeping $90 from themselves, which is great. Maybe it's only $1. That'll help you figure out the profile of the business, if it needs a lot of quantity and volume, or if it really needs to focus on service and obtaining high quality customers. And lastly is efficiency. How well do we use what we have? Inventory turnover is a great example of this. So you can look at a company and see, well, how often and how many times do we sell inventory? So you might see that a company sells its inventory twice a month or once a year. The more frequently you turn over inventory, the better the business generally is doing, because they're not holding on to the inventory and all the associated costs with the inventory. So we can also look at AR turnover and other turnover ratios to see how effectively we're collecting cash, how effectively a company is paying its bills, etc. For current liabilities, if you have a $50,000 current liability and $100,000 in current assets, you have a ratio of 2.0, a current ratio of 2.0. What does that tell you? Company's doing okay, right? The company's doing all right. They can pay their bills if they didn't make any more money for the next year. Current liabilities, current generally meaning within the next year or business cycle. So this company looks pretty healthy. And then we can look at their profitability and their sales and figure out how they will trend over time. And so I'll do that more in my live classes, but just give you an example of how you can quickly look at a company and say, hey, okay, this company is legitimate. They actually have enough money to survive for a while. So takeaways, like we just saying, financial analysis helps tell a business story, and you don't need to be an accountant to understand the basics. This is really helpful stuff. It's going to help you in your personal life. You can look for trends of your own finances, your friends' finances, if they tell you, businesses, not just single numbers, and you can see and extrapolate where it's going to go over time, which is just awesome, right? Your toolkit is just totally expanded in order to do business analysis and make decisions. So I hope you found this helpful. I think one big takeaway for me is if I just knew this when I was younger, I could have applied it to my own life in a lot of really interesting ways. If you were to look at yourself and say, hey, if I was a business, am I making wise investments in myself? Would I pay for the $100,000 a year college degree or the $10,000 a year college degree? Because once you think about it in that lens, you're going to look at your return on investment and say, okay, well, if I do the $10,000 a year college degree, do I need to get a job to pay that? How long will the debt last? And then what would the job market look like? Because I'm ultimately making these cost investments in order to have a return eventually. And so I better get a good job. And you might find out that your $10,000 a year college degree might get you the same job as the $100,000 a year college degree. Or maybe you don't need a college degree at all and you actually don't want to do any of that stuff. And there's so many people that I've met in my life that they go through a fancy degree program, take on hundreds of thousands of dollars of debt, and then they change their career when they turn 23 because they didn't like anything that they did. And now they're in debt. You can give advice to your friends that way, though they might not like it. It depends on your friends. Some people love it. Or you could look at other businesses when you're making investments. And so this just opens up your world to just phenomenal ideas. I think it's going to be really valuable to you all. I hope you enjoy the lecture. We're going to do a lot of stuff next time. You all rock. Appreciate you. Take care. Bye-bye.